Again, my name is Jody Tiernan from Tiernan and Associates. I come to you from Union, Ohio. And again, if anyone has any sound issues, please do not hesitate to bring those up. Our contact information, like I just mentioned, is on my contact information is listed there as well. So again, don't hesitate to use the chat box to the bottom left. We'll be more than happy to answer those questions that we can. But again, if you have specific personal tax questions that you'd rather not ask on a public forum, again, please don't hesitate to either email me or again, contact my office at the number that's listed here. So it's a minute after 8 o'clock. I think I'll begin. Again, my name is Jody Tiernan from Tiernan Associates. We come to you from Union, Ohio. Again, I will mention one more time, if you have any questions, don't hesitate to use the chat box bottom left. A few moments about us, Tiernan Associates. For some of you who've never heard me or my father, Tom, speak, we've been doing this, I'm quite proud to say, for almost 35 years now. Over those years, our niche has been MaryKay. When I was in grade school, my teacher happened to be in MaryKay. She was a director. And that's basically where we began in 1980. We started with one person in our area, and we are from Southwest Ohio. Started from one person who knew someone in Dayton, Ohio, which knew somebody in Chicago, which happened to know somebody in Seattle. So our business has steadily grown through all those years. Over those years, we processed thousands of tax returns. My father happily retired in 2006. I have since bought the business from him in 2006. And I'm quite happy to say that we continue to grow. Our niche is MaryKay. And what I'm going to talk to you tonight about is that because we process so many thousands of MaryKay tax returns over almost 35 years, that over those 35 years, we've learned quite a bit. But with dealing with so many people over so many years, we've spent a few times in Internal Revenue Service, and a lot of those times were specific to your business, MaryKay. So what I want to talk to you tonight about is not just what we've learned in classrooms, not what we've read in specific tax periodicals. It's specific time with the Internal Revenue Service. So what I'm going to talk to you tonight about is evidence of what does and what does not work with your MaryKay business. And I think that's very, very important that we have actual experience with the IRS in dealing specifically to you folks. And I think that's crucial. So tonight what I'm going to talk to you about is not all the stuff that you need to keep track of. If I were to talk to you about that, we'd go on for hours. But what I am going to talk to you about are some of the things that I think are crucial for you to know and for you to keep track of. Some things you may not need to worry about, and a couple of things that may actually help you in recruiting. How maybe taxes can help you make money. And those are just some of the points that I'll be talking to you tonight about. Again, for those people who have just entered the chat room, there is a chat box to the bottom left. If you have any questions, don't hesitate to ask those questions at this time. My associate Jack is here with us, so he'll be taking care of those questions. I want to start with some things you need to keep track of. Things you need to keep track of specifically with Section 1 items. Specifically with Section 1 items. I know what you've bought and I know what you've sold, but other than those two things, there's 5 different things that you need to keep track of. The first thing is, of course, what everyone in MaryKay is going to have is some personal use. You have to have personal use. The next item that you want to make sure that you keep track of is demos. Demos or samples, whatever you want to refer to those, you got to keep track of that as well. Also, in addition to that, what you need to keep track of is your hostesses. Hostesses. hostess credits, hostess gifts, whatever you'd like to refer to those as. The other thing that you're going to want to make sure that you keep track of are gifts of Section 1. Gifts of Section 1. Now, there's a limitation to this, however, of $25 per person per year wholesale. $25 per person per year wholesale. You say that's not a lot, and I would agree. It's very old tax law that they still implement, but that is the law. No more than $25 per person per year wholesale. The fifth item that I've been discussing in recent years is what happens if you want to give product to a serviceman or woman overseas. You happen to box up a bunch of stuff and you send it out. Are those items that you give to members of the forces overseas, are those going to be considered gifts or charitable donations? They're going to be considered a gift if you give it to an individual. So if you have a box of stuff that is more than $25 wholesale, then instead of gifting it to that individual, what I suggest that you do is you donate to that charitable organization, such as your church or some 501c entity. By you giving it to them and then they ship the product off to the folks overseas, that then becomes a donation and is not subject to that limitation. Again, if you donate, it's got to go through a charitable organization, one that the IRS recognizes, then there is no limitation as to how much of those Section 1 items that you wish to give. The difference between that and a gift is that if a gift is to an individual or to a business, that there lies the issue that it's only limited to $25 per person, business, per year. So again, those 5 items are personal use, demos, hostess credits, gifts of Section 1, and donations. Now, what about if you've got something on your shelf that's been on your shelf for quite a while? You can't sell it, you feel, you can't donate it, you can't gift it. The product's even expired, it's so old. What do you do with that product? It is my suggestion that you never throw away product. Never throw away product. But instead of throwing the product away, especially if it's a colored item, you should do what? You gift it to a funeral home. Gift it to a funeral home. Now, by being a funeral home and a for-profit entity, it's still going to be limited to $25 per business per year. But if you gift it to that funeral home, there's a better chance of you making maybe a little bit of advertising with that instead of just throwing it away. Never throw away your product. So what about that item? And I get this question often. What if you've got a product on your shelf that MaryKay considers that discontinued item? Do you still account for that as part of your inventory? Absolutely. It doesn't matter whether MaryKay considers it out no longer available. Is it still possible for you to sell it, donate it, use it as personal use? If it's possible for any one of those reasons, you still want to make sure that you account for it as part of your inventory. Doesn't matter what MaryKay says. If it's no longer a product for them, it's still an item that you could sell. Still include that as part of your inventory. Those are the 5 things. Now, do you keep that in retail or do you account for that in wholesale? The answer is wholesale. We want to know what the wholesale value is. So how do you keep track of it? It's based on my opinion, and I've been doing this for over 20 years now, but it's based on my opinion. You just simply write it down. I know the software programs are very popular, The issue with the software programs, however, is in my opinion, the people who create the software programs do not educate you folks well enough as to how to use those. If you feel comfortable with using software for these items, then certainly go ahead and use it. But just please be sure that the information that software spits out is accurate. Very important. But again, my opinion, just simply write it down. Those are the 5 things you need to keep track of when it comes to Section 1's items. The next area I want to talk about is 3 weeks ago, all of you should have done what on December 31st? On December 31st, you have the choice to either have a good time and or what? Count your inventory. Exactly, you're correct, Sarah. Now, knowing MaryKay folks as long as I have, and then living in the real world, I understand that folks have a tendency maybe not to do their ending inventory on December 31st. You have the choice of spirits or count what's on your shelf. So, all I ask from my clients is that you do this. At least estimate what you think you have on your shelf as of December 31st. At least estimate it, especially for you folks who've not done it yet. Because if you've not done it yet, is it going to be correct? Absolutely not. Because since today versus December 31st, you've taken things off the shelf, put things on the shelf, so it's not going to possibly be accurate to take your inventory now. So what I'm asking you to do is to go back and try to estimate what you think you had on that shelf. Now the question is, why do we even have to do inventory? What's the significance of inventory? Do you really care what you had on your shelf on that specific day? Probably not. Do you really think that your director cares what you had on that specific day? Probably not. But who does care? The Internal Revenue Service cares. So why do they care about my inventory? The issue is this. It helps determine how much money you make off of each mascara and lipstick that you. How much can you possibly make for every item that you? 50%, right? That's the most you can make. But on average, for a lot of you, you may only make 40 or 45%. That ending inventory number will determine that percentage. If you work with Tiernan Associates, we help you with that. Even if you've estimated a number, or even if you've done your own inventory on December 31st, if your ending inventory we believe to be incorrect, we ask you questions about that. Because we want to make sure that it's somewhere in that 40% bracket, somewhere in there. I've seen returns where either people have done their own return or they've had someone professionally do it who's not familiar with MaryKay, and they end up with percentages of only making 5% or -%. Is that at all possible for you folks to make only 5% or -%? That's where you give people money to take away the product. That's not possible. And again, you only may end up with 5% or -% because you did your ending inventory incorrectly. You've given them a wrong number. So what we ask our clients is that if we do get the wrong number, we'll ask them questions. And we can help you make sure that we're at least in the ballpark with your ending inventory. Because no one else is going to know what your ending inventory number is. We want to at least get it close to where it should be. The last thing that you ever want to have happen, and the chances are highly unlikely, but if the IRS were to ask you about this, and they know that you can make 50%, but yet you're telling them that you only make 5%, you don't want to try to convince the IRS that you're making only 5%. That's just not going to be correct. So we help you with that. Huge advantage of dealing with Tiernan Associates. Huge advantage. For some of those folks out there that actually did their ending inventory, a lot of times we still find issues with that. One issue being is that you didn't do it on, if you did do it on the correct date, then trying to locate all the product and making sure you've accounted for all of it. That's the second issue with not doing it on the correct date. Second issue is making sure you account for it. The third issue is did you account for the retail or did you account for the wholesale amount? And then the fourth issue is what did you do with all that free product that you received from MaryKay? Did you account for it as part of your inventory? If you did, that's not correct either. You want to make sure that for any free product that you get from the company, you did not include as part of your inventory. The reason is because you never purchased it. If you never bought it, then the problem is that you never bought it. It should not be accounted for as part of your inventory. So just keep that in mind. Those are the 4 issues with doing inventory. So if you've done all that, you've done it correctly, then we still evaluate and make sure your inventory is still at least very huge advantage of dealing with us. We make sure that there's no issues with that. Next area I want to talk about is sales. Sales is exactly what you believe they are. But this is the thing when it comes to sales, and this is a question I get a lot, is if you've got an item that you sell for $10, you don't sell it for $10. Instead, you sell it for $8. What happens to the $2 that you've lost? Is that considered advertising? Is it considered this or that? The $2 that you did not collect just goes nowhere. Doesn't go anywhere. So what I suggest that you do is instead of giving away the $2 and not as a discount, what I am suggesting that you do is instead of giving away the $2, give away free product instead of the $2. Take an item that's worth $2, that this would be something as small. Instead of giving the discount, give a free product. Give a free product. That is what my tax suggestion is. With a $2 discount, you get no credit for it. With a $2 item, the $2 gift, you get some credit for that. Again, if you've got the discount thing going on and you're comfortable with that, then so be it. But again, that's my suggestion. Now, the next area I want to talk about is the other type of income that you've got. Other than your sales, what is the other type of income? Those are your commissions from the company. So those of you who received commissions, you're going to receive a 1099 miscellaneous. MaryKay refers to it as income advisory statement. From what I understand, you folks should receive this in your InTouch account by February. So if you get one of these, it's imperative to file a return. So what about those of you who don't receive a 1099 from MaryKay? The question is who has to file? Who has to file on MaryKay? What if I only sold $200? What if I only sold $400? What if I only sold $600 as? Well, the question is of those products that you sold, did you sell those products for more than what you bought it for? As an example, you've got an item that you could sell for 10 and you bought it for 5. If you sell it for that $10, if you sold it for more, then you have to file. If you buy something for 10, if you buy it for 5 and you sell it, then you have to file. You're selling it for more than what you bought it for. So then I get a lot of questions, well, what if I only sold $200? What if I only sold $400? Then the question is, if that's all you did for the year, let's say you're brand new in the business and that's what you've done. Let's say you're brand new in October and you sold $200 or $300. Then the question is that if you don't file, what do you have for a store? What do you have as inventory? If you've got an inventory of more than a couple $100 or only a couple $100, then maybe it's not worth it to file. But if you've got inventory, if you've got stock on your shelf that's worth a couple $1,000, it's very important you file. And the reason that you want to file is that if you don't account for that inventory in the year that you purchase it, then it just simply goes away. It just goes away. So again, if you sell product for more than what you bought it for, you, as far as the IRS is concerned, you have to file it. However, if you only sell a couple $100 and all you have is a couple $100 on your shelf, then maybe it's not worth it for you to file. But if you've got any inventory as of December 31st of 2014, you're going to want to make sure you file that, because the inventory that was purchased in 14, if you don't account for it on a tax return, it just goes away. So what are some of the advantages of filing a return? First one, in my opinion, is that if you tell your spouse you're out traveling, you're out doing Monday or Tuesday night meetings, you're going to Saturday seminars and such, you're out, you're busy, you've got a business, you're making money, and you try to convince your spouse that you don't file a tax return, then the issue is the business. If you don't file a tax return, then you have no business. So it's my opinion that one of the reasons which files is to solidify with no one else other than your spouse that you actually do have a viable business, and it's worth your time and effort to work it, because you know you will make a very, very good amount of money, and I know that to be true, and you will do very well. So that's the first advantage of filing a MaryKay tax return. The second advantage of doing it is that if you're doing well in MaryKay and you want to purchase or refinance your home, and you tell your bank that you're doing well in MaryKay, and if they don't see your MaryKay tax return, again, do you have a business? You don't have a business. Imperative that you file the return for bank purposes, to buy a home or to refinance a home. The third advantage of filing a MaryKay return is, for the reason that so many of us in the first 2 years of most businesses in this country, on paper, your expenses outweigh your income. You end up with a loss. If you end up with a loss, that then reduces the family income, which will then in turn reduces the family tax. And in the majority of the cases, you end up with a larger refund because of the MaryKay laws. So those are the three reasons in which to file a MaryKay tax return. The next area I want to talk about is, for most businesses, no matter how large or how small, the biggest problem most businesses have is paperwork. Now, there's two extremes when it comes to paperwork with MaryKay folks. You have two extremes. One extreme being the one we all know. That's basically where you don't do anything. The other extreme is where you get way too involved in what I like to refer to as charts and graphs. You got too much time and effort into bookkeeping when you should be doing what? You should be selling or recruiting. So what you see there on our whiteboard is our expandable filing system. The advantage of doing this, that expandable file, is it lists all the different categories that who's going to want it in those specific categories. The Internal Revenue Service. They ask for, if ever audited, again, chances highly unlikely, but if they were to ever ask about your paperwork, they would want to see your information in those different categories. And expandable files are already set up for those. So what you do is you have a filing system in your car. And the reason in your car is because that's where you collect most of your receipts. You go and drop off product at the post office. You put the receipt in office expense. Immediately after that, you go and try to recruit a person that you take her out to lunch. Now you have a meal receipt. So you put that in meals. So you have all these different categories, and then at the end of the year, you take those different categories and the calculator tape, you add up those different receipts in each of those categories, take that calculator tape and staple it to that stack of receipts. Now, why do we do it like that? Because the IRS wants it done like that. Now, for a lot of you out there, you're scanning it and sending it to the cloud. That is fine. A lot of you take pictures of your receipts. Again, that's not a problem. However, if the IRS ever does ask for your information, then you're going to end up having to put it in the form of a paper. You got to put it on paper. not going to take anything in the way of tech. You can give them a flash drive, you can give them a CD, any of the above, and it's not going to matter. They don't want the receipts stapled to a calculator tape. That's exactly how the IRS wants it. Who's the last person you ever want to have do your bookkeeping? Who's the last person? In my opinion, it's your spouse. Who's the last person you ever wanted to have do your tax return? Again, your spouse. Why am I suggesting not having your spouse do this? Well, the question is do you want that person to start asking lots of questions about your business? Do you want that person to review your credit card statement and start asking all these questions? Am I suggesting that you hide things from your spouse? No, maybe, I don't know. But if there's a lot of discussion about this with your spouse and there are some disagreements, what might this lead to? Marital discourse. So do we want to go there with our spouse regarding this? I would suggest not. Remember, this is your business and it's your responsibility. So if you look at this and say, I don't really want to do this, it takes too much time, then we can do your bookkeeping for you for $45 a quarter or $60 a quarter for consultants, depending upon your income. We can do your bookkeeping. Again, $45 a quarter or $60 a quarter for consultants and $90 a quarter for directors. Now, for some of you, that may seem like a lot of money, but you got to consider how much time and effort it takes you to do your bookkeeping. How much time does your paperwork sit on the dining room table and your spouse asks you, are you done with that? Are you done with that? Are you done? So leave it to us and we can do it for you. You send us your receipts on a monthly basis. We send you a profit and loss statement every quarter. Right now, this time of the year, the end of January, we're finishing up a lot of bookkeeping that we get through the year, and it's already done for you typically by the first week of February. What you'd end up having to do is just send us the rest of your personal tax information, and your MaryKay would be done. Now, the $45 or $60 a quarter for consultants, the $90 a quarter for directors, that's 100% deductible for you. So something to consider for you folks. That is bookkeeping. The next area I want to talk about is generally the largest expense that you're going to have on your business return. If you think about it for a moment, what would it be? And that would be mileage. A lot of folks never like to take care of their mileage. They don't want to keep track of it. It's a pain in the tuchus. It takes a lot of time. But this is the thing, folks. It can be worth a lot of money to you. It could be a tremendous amount of money to you. So you just want to make sure you do it correctly. So what you need to do is you need to document. I don't care if you do it in the form of a piece of technology. If you want to use your smartphone, that's fine. If you want to simply write it down, that's fine too. But these are the three things you're definitely going to need to make sure that you list as mileage documentation. You need to take the date, where you went, and how many miles you drove. The date, where you went, and how many miles you drove. Now, if you do this in the form of some type of technology, a smartphone, iPad, whatever, again, it's imperative that if ever asked, you'd have to provide this in paper form. Just keep that in mind. Now, a lot of people will give me all sorts of variations. Well, what if I do this, or what if I do that? Well, another huge advantage of dealing with Tiernans is this. When it comes to your mileage, we always determine every return that leaves here that has a business and who has business mileage. We always determine its reasonableness when it comes to your mileage. This is huge, huge. How do we determine for a MaryKay consultant or director, how do we determine whether something is reasonable or not? Well, the question is, where do you live and how much money you make? Those are the two items that determine whether your mileage is reasonable. As an example, For a lot of the folks this evening, they're in the Boston area. And I wish all of you folks the best of luck in the next 48 hours. But anyway, for a lot of you folks, you live in the Boston area. There's a lot of people there. Now, take where you live and compare that to somebody who lives in Montana or Wyoming or either one of the Dakotas. Well, for a lot of you who had to go to work this morning, you pass more people on the way to work than the people who live in Montana. Montana is a beautiful state. However, there's just not a lot of people that live in Montana. So, if you compare yourself, if you do live in the Boston area or in any metropolitan area, compare yourself to somebody who lives in the middle of Montana and they have to drive and drive and drive compared to where you may only have to walk to see 1,000 people. They have to drive to see 1,000 people. So again, if you compare yourself to them, how many miles does it take for you to drive to make $1,000? It may only take 500 miles, 1,000 miles. But if you compare yourself again to somebody in Montana, it may take them 3,000 or 4,000 miles to do this job. So we always determine, again, how much money you make and where you live. It's a huge, very important, because for those of you folks who decide to do this on your own or to take it somewhere else professionally done, the issue is you or them may not determine whether it's reasonable. In experience, the number of years that we've done this and the number of returns we process, we know what is reasonable, and we always evaluate that. We, again, want you to have no issues when it comes to the Internal Revenue Service, so we'll always evaluate that. If we have concerns, we will definitely contact now to make sure that there is no confusion on your part. So, not only do you need a mileage log, Tiernan Associates will help you determine whether it's reasonable or not. But in addition to that, you need to make sure that you have a third-party write-off of your odometer reading. A third-party write-off of your odometer reading is what? That just simply means another party, a third party, give you some type of receipt that you got so many miles on your car. That consists of any type of maintenance record that you may have. It doesn't even have to be a paid-for service. It's just got to be done by a third party. A lot of times you could just do a 21-point inspection or a 100-point inspection, whatever. They may not even charge you for this, but it's got to be on their receipt, their name on it, and an odometer reading. Extremely important that you have that third-party odometer reading. I like at least 2 of those a year. You say, I've been in this since July and no one's ever mentioned this to me. Don't fret about it. Just get one as soon as you can. Again, if you got in July and didn't know anything about this third-party odometer reading, don't worry about it. Again, just get it as soon as you can. And just keep that in mind from now on. You got to get that done. So in addition to your mileage being worth so many cents per mile, you're going to have parking and tolls. Parking and tolls in addition to that. Also, the next area I want to talk about is depreciation. Depreciation. What is this? This is stuff that costs more than $100 and pretty much anything in the way of technology. We're talking smartphones, we're talking iPads. There may be a desk involved somewhere along there. But the issue is mainly, for most of you, technology. Now the thing is, this to me is a huge recruiting tool, because folks are going to buy these items no matter what. But now because they're in a business, they can write them off. They can write off the purchase of all this technology that we have. But the question is this: are you making money to justify the cost? Are you making money to justify the cost at $600 iPad? Very well, you might be. But Tiernan can also help you with that as well. It's important to realize that the more money you make, the more things you can have. The more money you make, the more things you can have. Makes sense, doesn't it? If you take somebody that only made, if they were in business for the entire year and they only made $100 or $200, do you need a smartphone? You don't need a phone at all. Like I mentioned many times in my seminars, you just simply yell at the front door and somebody will give you $100 to be quiet. Same thing for any type of computer, whether it's a handheld device, whether it's a laptop or a desktop computer. If all you make in 1 year is $100, then any information that you need to store just simply will be on the back of your hand. If that's all you made for if that's all you made is $100 in 1 year. So huge incentive for you to work. Huge incentive for anyone who would want to join MaryKay, because they're going to buy the stuff. But now, because of them being in business, they can write it off. Huge recruiting tool, in my opinion. Huge recruiting tool. But this is important, and I'll allude to this in a few minutes, is that can you write off your smartphone or your iPad? Can you write 100% of that off? Is it possible to convince me or the IRS that your phone is 100% usage? Absolutely not. So what is the percentage? What's the most you can take on any of these items? The most you can take is a percentage that I've based off of my times that I've been to the IRS. Because the IRS is only going to give you maybe 40 or 50%. But the average taxpayer is going to say I used 100%. So where's that fine line? No more than 70%. No more than 70% for any type of technology that you purchased. Technology, depreciation, stuff that costs more than $100, huge recruiting tool for you, huge incentive for you to do well, because the more money you make, the more stuff you can have. Next area I want to talk about is Tiernan Associates. Tiernan Associates. So I've already talked to you about our history. Been doing this a very long time. Spent over almost 35 years. We spent time with the IRS, so we know exactly what they're looking for, specifically with you folks. But in addition to that, we really want you folks to succeed. We all want you to drive something pink eventually. So why do I care whether you drive something pink or not? We all want you to exceptionally run this business, because the way that my father looked at it before me and the way I continue to think like him is that the more people that you know, the more people that I know. The more people you know, the more people I know, the more money you make, the more money I make. So we are here to help you. If you've got questions, if your recruit has questions, a possible recruit, we're going to try to recruit them as much as you are. They're your recruit, and there's a very good possibility they're our client. So we have as much incentive here as what you do. And the last thing you want to do is to go to a preparer that's not familiar with MaryKay, doesn't understand your business, and the last thing you want your spouse to hear is from a tax preparer, a professional preparer, who says, why are you in this business? Because you're just simply going to lose money. We will never suggest that, because that is not correct. So we're here to support you with the IRS or whatever state you live in, but more importantly, we're here to support you, your spouse. And I think that's worth a lot. So I spoke to one just today. He felt much better after he got off the phone with me. And I could do the same thing if you've got issues with your spouse or your recruit's spouse. We can definitely help with that. The thing is this, is that we're here to help, we're here to support, we're here all year long. And even though tonight I'm talking to you about MaryKay, what happens, God forbid, if you lose your job in a couple weeks and you need to take money out of your 401k? We help you with that. Or sometime through the year, you've now, because of a death benefit, you received $80,000. Is this going to be considered taxable to you? Is it not? We're here to help you with that as well. So even though I'm talking to you tonight about MaryKay, you can ask us any type of tax question that you wish. Even if you are not our client, I'd rather you ask us than your neighbor who has absolutely no tax knowledge whatsoever. We're here to help you, and we're not going to charge you for those phone calls either. Not going to do that. So the bottom line is, how much do we charge? How much are we going to charge? We are exceptionally economical compared to most, especially Northeast in the New England area. We're going to be much more economical than the franchise folks, and we have a tremendous amount more knowledge. That's all there is to it. On average, for those folks who live in the Northeast, this would include not only your personal return, this would include your MaryKay, this would include the state of Massachusetts if you do live there, and also with the state of Massachusetts, you have your health care. But in addition to that, the price that I'll quote you also includes, new for every taxpayer in this country this year, is the Affordable Care Act. That's going to impact every taxpayer this year. So the price that I'm going to suggest to you is going to include all of the above, personal and business, state, plus the Affordable Care Act. On average this year, anywhere from $180, $240, maybe $250 for all of the above. And of course, on average, if you have investments or rentals, it could be more than that. But that is exceptionally economical, very economical. Now, are we going to be more than the do-it-yourself tax software programs? Yes, we are. But the difference between us and them is that if for whatever reason you happen to put your incorrect mileage down, and let's say, for example, you only drove 3,000 miles, but inadvertently put 30,000 miles down, the do-it-yourself tax software programs aren't going to tell you that that's not reasonable. If your inventory is incorrect, it's not also going to tell you whether it's not possible. So what you're paying for with Tiernan Associates is someone to actually sit down, prepare your tax return with thousands of hours of experience that will point out to you, are you sure about this specific deduction? Are you sure about this specific deduction? We help point out those possible red flags that you yourself would ordinarily not be able to identify. And that is worth a couple more dollars for us to do it. The new do-it-yourself tax roll programs, their prices continue to go up. So our price versus theirs isn't going to be that much different. So again, we're here to help you do well in this business. So how do you work with Tiernans? As you can see on the whiteboard, this is our 2014 organizer. What we ask our clients to do is to fill this out to the best of their ability. It's $5 for brand new clients. And for those of you who are already our clients, you should have already received a letter with the username and password to our website to access this. But for those folks who are not familiar with this, in the first part of the book, we ask you specific personal tax questions where we wish you to fill out. And then the second part is where we ask you specific MaryKay tax questions. As an example, we ask you total sales, total purchases, total advertising. If you do the bookkeeping, we ask you to add them up and put them in this organizer. Again, first time charge for our clients is $5. If you wish us to mail you the book, it's then $10, but you can access it on our website, and again, that's only $5 for new clients. The purpose of the organizer is not only for us, but mainly it's for you to make sure that you have all the information that you should have, especially if you're brand new to MaryKay. There's all sorts of items listed in there that you may not even be familiar that you can have. And that's one of the purposes of that organizer, is to make sure that you have everything. Again, first time clients, $5. How do you get that? You simply contact our office, and there's the phone number again there, and there is the email address, one of the email addresses that you may use as well. Next area I want to talk about is a lot of questions about internet, a lot of questions about cell phone. What can be deductible? When it comes to your internet, No matter where you live in this country, most people have it bundled. You got your home phone, you have your cable. I don't give two hoots about either one of those. But part of that bundle is your internet. I want to know how much just your internet bill is. Just your internet. And how much can you possibly write off of that internet for the year? How much? As a percentage. What did I mention a few moments ago? No more than 70%. More than 70%. Now you can use less than 70%. You can use less than, but not more than 70%. So what about your cell phone bill? Cell phone bills are always interesting, especially if you have a spouse and children that have cell phone bills. So what I want you to do is all you'd have to do is look at your business card. Your business card's got a cell phone number on it. Then you go to your cell phone bill. On your cell phone bill, that number that's on your business card has to correspond to a number that's on your cell phone bill. And it's just that dollar amount for that specific cell phone is what we need. So if there are 3, 4, or 5 people on that one bill, there we go. Apologize for that. So again, I just want when it comes to cell phones, I just want your cell phone number associated with the cell phone dollar amount. So you could have multiple cell phones, but I just want yours. How much of that are you going to be able to percentage? How much of that? No more than 70%. So if you are a secondary person on that line, then what do I suggest that you do? Become the primary person on that cell phone bill. So you get the bigger bang for your buck on that. So again, whatever your cell phone specific to your cell phone number, that amount no more than 70%. Less than 70, but no more than 70%. And remember, it's have to have the receipts. Gotta have the receipts. Very, very important. Now, a lot of these bills may not have your name on it, and that's fine. It doesn't have to have your name on it. It may have your spouse's name on it. As long as you're a member of that household, you're fine. There's no problem there whatsoever. Next area I want to talk about is how to take a business trip. How to take a business trip. Now, we all know how to take vacations, but how do you take that business trip? The first thing, very important, is that you have to have the intent. You have to have the intent to do business before you do business. I often get the question, I happen to be on a cruise, and when I was on that, I sold a lady some stuff. That's nice, but the cruise is not going to be deductible because you did not have the intent to do business. So how do you validate intent? What you do is that, say, for example, that you have a relatively much warmer climate. Let's say South Florida as an example. So what you would do is you would email a friend, sister-in-law, whomever, that lives in South Florida. You email her and ask if she would like to have a party. So then what she does is she provides you with names and emails of folks, and then what you do is you email 15, 20 different people in South Florida, and you happen to live in the Northeast. Of those 20 people that you've invited, of those people, the 10 that show up, you have to sell and recruit or recruit. Because if you go to South Florida this time of the year and you happen to live, the IRS is going to think this is pleasure, of course. So when you're in South Florida, you have to make money when you're there. You have to produce. Because if you go to South Florida and you do not produce, you don't make any money, then what do you have? You have a business trip or a vacation? Well, of course you have a vacation. So what you've got is you first have to have the intent to do business before you do business, and that is the invitation. So once you've established that, then once you're down there, you have to sell and recruit. What do you have to sell? At least $50 a day, $250 a week, or recruit one person per week. Now, this is not IRS code. This is just Tiernan and Associates suggesting to you that you've got to at least make money while you're there. There's got to be a minimum amount that you have to make. Now, if you go down there, you've done the intent, you've made the money. Now, what are you going to be able to enjoy? You're going to be able to enjoy the deduction of the flight, any meals in South Florida, the rental car, the hotels. It's a beautiful thing. It's a huge incentive, huge incentive. MaryKay, she herself always suggested that you recruit at least in 5 different places. So huge incentive for you to do well in this business. And again, I think a huge recruiting tool, because you can't go to your W-2 job and your supervisor and say, well, you know, I just want to go to Fort Myers this week. You normally can't do that. Huge advantage of being in MaryKay. Definitely huge advantage. So again, gotta work to get it. Because of this business, I've seen most of this country. But if it wasn't for my job, if it wasn't because of Tiernan Associates, I wouldn't have seen it. Again, it's a wonderful reason to be self-employed, folks. Wonderful reason. Next area I want to talk about is office in the home. Office in the home, it's a wonderful deduction. We are talking about water bills, trash, utilities, home insurance, the value of our home. Things now that can be deducted that couldn't be deducted before when you weren't self-employed, but now because you have your own business, you can write these things off. And the wonderful thing about it is that you're going to spend this no matter what. Right now, you've got the heat turned up, I'm sure. So if you weren't in business, you couldn't write it off, but now that you are in business, you can write it off. So what are the things you have to do? You have to have a room specific to MaryKay. You measure the room, then you take that and divide it by the total square footage of the house. And for most folks, that equals anywhere from 12 to 15%. The room that you use specific to MaryKay, you take that, divide it by the square footage of the house. You come up with a percentage, and like I mentioned, 12, 15, 17% is normal. And then it is of that percentage that now you could take a portion of your utility bill and home insurance, repairs and maintenance. Now you could take a portion of those expenses that, again, you're going to spend that money no matter what, whether you're in business or not. But now that you are in business, you can take those items. So it's a huge deduction. Wonderful deduction. Next, I want to talk about real briefly, and that's hiring children, grandchildren, hiring children or grandchildren. I will be on here for approximately another 7 or 8 minutes. So if anyone has any last questions they wish to ask, please feel free to do it. But the last item I really want to hit is, again, hiring children. Real quick, to Heidi, doesn't need to be in your name. If it's in your spouse's name, back to the utilities, about office in the home, it does not need to be in your name as long as it's in your spouse's name. That would be fine. But hiring children, grandchildren. If you wish to hire a grandchild or a child to help you in your business, it can be 100% deductible with very little paperwork. And this is how you go about doing it. What you do is you establish a pay rate based on their age. A pay rate based on their age. So an 8-year-old isn't going to be worth as much as a 17-year-old because a 17-year-old can deliver product, correct? Absolutely. So because that 17-year-old can't deliver product, maybe they're worth $7 or $8 an hour. And don't worry about federal minimum either age requirements or wage requirements. These are your children, grandchildren. That's not an issue for you. So don't worry about the minimums of any of this. So if you pay your $17 an hour, what you do is you write it out of whatever account that you have for your MaryKay. You write them a check throughout the year. Don't just write them one check. Don't do that, but write it throughout the year. Write them that check throughout the year, goes into their savings account. Now, what happens to that money that goes into their savings account from the check that you've written out of your MaryKay account? What happens to that money? Whatever you wish. You could fund college with it. They could go buy video games with it. It does not matter to the Internal Revenue Service, but there has to be that paper trail. Very important. Very important. So you set, one item I did forget is that you set the wage per hour, but then in addition to that, you got to give them an itinerary. This is what an 8-year-old can do. This is what my 17-year-old can do. And again, you pay them throughout the year. Under the age of 18. Very important. Under the age of 18. Under the age of 18 for children, grandchildren. This does not include daycare. Daycare is in a completely separate form altogether. This is where they work in your office, help you grow and maintain your business. Children, grandchildren under the age of 18, and you pay them no more than $599. No more than $599. Anything more than that, you got more paperwork. Anything more than $599, you got more paperwork. So again, pay them out of your MaryKay account, directly goes into their savings account. You got to set up a wage per hour for them and an itinerary for them. Wonderful deduction. But you got to remember, if you only made $200 in 1 year, please do not pay your children almost $1,200 a year. So again, the more money you make, the more things you can have. So another wonderful deduction. Now, I'm going to just briefly show you this. This is our questionnaire regarding the Affordable Care Act for you folks. Whether you're Tiernans or you've been a long-time client with us, we ask you to fill out one of these 2 pages. I am not going to go into discussion with it. On our website, which is right here, this is our website. You can go to that, and I've got a very brief video concerning the Affordable Care Act I wish you to watch. We just want to make sure that I hit on a couple points. Need to fill out the paperwork, and we just need a copy of your insurance card for 2014. Fill those pages out, insurance card for 2014. Couple more seconds about Tiernan Associates. Again, we are here to help you. Please feel free to ask us anything. I've seen that the chat box has been exceptionally busy tonight. For whatever reason, we did not answer your question, or you don't really want to display it on a public forum, please, again, do not hesitate to contact us with the information that's currently on the whiteboard. We are here to help you. We are exceptionally reasonable. We ask that you fill out that organizer that's on the whiteboard right now. Fill it out to the best of your ability. You call our office. It's $5 to those first-time clients. The username and password. When you go through it to fill it out, any questions, again, do not hesitate to contact us. We process tax returns. This past year, 2013, there were like 3 or 4 states that we didn't process a tax return for. So if you live in the Northeast, whether you live in Connecticut, whether you live in the state of New York or Massachusetts, we have processed all of the above. We're quite familiar with all the states and their taxes associated with them. So please again, if you have any questions, we'll be more than happy to talk to you, whether they're MaryKay related or not. Send us the organizer completed to the best of your ability. Send us all the normal tax information, W-2s, 1098 statements, all that normal stuff. And when can you send the completed organizer along with the other normal tax stuff? Anytime after next week. Normal turnaround time is anywhere from 7 to 10 days. If it takes longer than that, then we should have already asked you, and we're just waiting on your response. How can you get us the information? You can either mail it to us at the address that's listed up here. You can either mail it to us, you can fax it to us, which is listed also on that sheet. You can scan or email it to us. It is whatever you are most comfortable with, whatever you wish. If you deal with a paid preparer this year, please, I warn you of one thing. Two things, actually. They're not going to be familiar with your MaryKay business, so you should bring probably a sack lunch when you go because you're probably going to be there a very long time. The other item is this. They, in my opinion, are really going to charge for the Affordable Care Act this year. It is the mindset of those franchise folks that they are going to make a lot more money because of that. For us, in dealing with the Affordable Care Act, our prices are going to be anywhere from $10 to $25 for the paperwork associated with that. Now, if we charge you more, it's just simply because it's going to take more paperwork. For most of our clients who have insurance, who had insurance for the entire year, $10 charge is probably all that it's going to be. It's those folks who only had it for a portion of the year, went to the exchange, then the price could be more than that, but no more than $25. So again, if you do decide to go to the franchise folks, please be sure and ask them what it's going to cost for you to do their return. That includes the MaryKay, because oftentimes in the past for the MaryKay it costs anywhere easily $300 to $400, and I think this year it will be well over $400 for a lot of the franchises. So again, if you believe that it's easier to go just down the block to have somebody do return, please be wary of the cost associated with it. Jack and I are going to be on here for another few moments, so if those folks still have questions, I may no longer be visible to you, but we'll still be here if anyone has any other last questions. I thank you for all being here tonight, and I hope that you've all been able to stay warm and cozy and haven't been able to go outside tonight. And again, for those of you who are in the Northeast, I bode you very well in the next 48 hours. I wish you all the luck in the world for that. Thank you very much. I appreciate you all being here tonight. Again, there are many other items that I did not address tonight, just simply because when it comes to the webinar, I try to condense them down to an hour. So again, any questions, email our office. The email address is there. But again, if you want to email me specifically, please, again, don't hesitate to contact me via email. We'll be more than happy to work with you folks this year. One last item, and then I will all let you go. I always get questions about what if I didn't file my return last year, or I didn't file my 2012 return. We have at one time filed for one client 10 years of returns. The only reason that she came to me after 10 years is because the IRS seized over $130,000 out of her bank account. And that was the only reason we ended up having to do her return, is because the IRS got that money. And that is, of course, not a normal situation, but she does extremely well in the business that she does. So we were able to file all 10 years. And because she did as well as she did, she only owed another $100 and some thousand. Again, not typical for most, but my point in telling you the story is that we can go back, and we can go back multiple years if you wish us to, or if you haven't filed. For those of you who have filed and are not really sure if your MaryKay was done accurately the year before, just send us a copy of it, either with your return or even before that. I'm not going to charge you if you just wish us to review the return. I'll be more than happy to do it at no cost to you. But for those of you who haven't filed, on our website, we've got multiple years of books there for you. So you just simply click on the one that you haven't filed, and we'll go back and file those for you. So for those of you, and I always get this question pretty much every seminar I go to, if you haven't filed, then don't worry about it. We can help you with that. I end that tonight, folks. Again, we will be here for a few more minutes if you have any additional questions. Thank you very much, folks. I wish you a good evening. Good night.